Welcome back to the Deep Dive. It is great to have you with us. Today, we are going to perform a little bit of an exorcism on your brain.
That is a very dramatic way to start a show, an exorcism.
It feels dramatic. But honestly, I was reading through the stack of research we have for today, and I had this distinct, uncomfortable feeling of being called out. You know that feeling? Like when you try to sell an old car, or maybe you're finally clearing out the garage and you list some old furniture online. You look at this table and you think, okay, this is a solid oak table. It's got history. We had Thanksgiving dinners here.
Right.
It's worth at least $200.
And then the internet responds, and they offer you $20, and they ask if you can deliver it to them for free.
Exactly. And your immediate reaction isn't just, oh, my appraisal was off. I guess the market value is lower than I thought. No, it's anger.
It feels like a personal insult.
A huge personal insult. You feel like the world is conspiring to undervalue your life and your history.
It is a universal experience. It feels incredibly personal. But what we're going to discuss today is that it's not personal at all. It's biological. It is a fundamental glitch in the human operating system that has been with us for hundreds of thousands of years.
We are talking about the endowment effect. And to really get to the bottom of this, we have pulled together a fascinating mix of sources. We aren't just looking at a dry psychology textbook here.
No, not at all.
We have a heavy-hitting investment report from Brown Brothers Harriman that explains why this glitch costs investors billions. We have a really nuanced academic study on gender differences in risk-taking that completely flips the script on the whole men take more risks stereotype.
And my personal favorite, we have a study involving chimpanzees, frozen fruit juice, and peanut butter that might just explain the evolutionary history of why we are so, well, greedy.
I can't wait to get to the peanut butter. That is the highlight for me. But the mission today is simple. We want to understand why we value things more simply because we own them.
And how we can stop this instinct from wrecking our portfolios, our real estate deals, and even, our decluttering efforts.
So let's start at the very beginning. If you've taken a Psych 101 class, you've probably heard of the mug study. But I want to revisit it in detail because I think people miss the nuance of just how weird the results were.
It is the classic starting point. This is from 1990, the work of Kahneman, and Thaler. These are the godfathers of behavioral economics.
Yeah.
You have to understand the context here. Before this study, the prevailing view in economics was that humans were rational actors.
Homo economicus, the logical robot.
Exactly. The idea was that humans operate like calculators. If I have a coffee mug and you want a coffee mug, we will find a price that reflects the true value of the mug.
It shouldn't matter who owns it initially.
Right. The market will clear at the right price based on supply and demand.
So if the mug is worth $5, I should be willing to sell it for roughly $5, and you should be willing to buy it for roughly $5.
Precisely. That is the rational prediction. So to test this, they took a group of Cornell University students, smart kids. They divided them into two groups.
Okay.
Group A gets a mug, a standard, university bookstore mug with the Cornell insignia. Group B gets nothing. So you have owners and buyers.
And they created a market right there in the classroom.
They did. They told the owners, check out your mug. It's yours. It belongs to you. Now tell us the lowest price you would accept to sell it.
And to the buyers.
They told the buyers, look at that mug. What is the most you would be willing to pay to get it?
Now, standard economic theory says these prices should converge. I mean, the mug is a commodity. It's mass-produced. It has a set value in the bookstore. But that's not what happened.
Not even close. This was the moment that really shook the foundations of traditional economics.
So what were the numbers?
The buyers looked at the mug and said, effectively, hey, it's a mug. I'll give you about $3 for it.
Which seems reasonable for a generic coffee mug.
Very reasonable. But the honors, the students who had been holding this mug for all of 5 minutes,
What did they say?
they demanded more than $7.
Wow. They wanted more than double what the buyers were willing to pay.
Double. And as a result, very few trades happened. The market it froze. And this wasn't because the owners needed the money or because the mugs were rare antiques.
It was just because the mug was theirs.
That's it. That is the definition of the endowment effect. The mere fact of ownership increases the subjective value of an item.
Subjective is the key word there.
It is. It creates a subjective reality. When you hold an object, your brain effectively bonds with it. It becomes part of your status quo. It becomes part of your identity, even if just for a few minutes.
And giving it up doesn't feel like a simple sales transaction.
No, it feels like a loss.
And we hate losing things.
We hate it at a visceral level. This connects to prospect theory and the concept of loss aversion. The psychological pain of losing something is roughly twice as powerful as the pleasure of gaining that same thing.
Wait, let's unpack that ratio because it's staggering. Twice as powerful.
Roughly, yeah. Think about it this way. If you were walking down the street and you find a $20 bill on the sidewalk, how do you feel?
Pretty good. Maybe a little skip in my step. I might buy a nice lunch.
It's a nice surprise.
Oh!
But now, imagine you have $20 in your pocket, you reach in to pay for coffee, and it's gone.
Okay.
It fell out through a hole in your pocket. How do you feel?
Oh, I feel terrible. I feel stupid. I'm retracing my steps. I'm annoyed for the rest of the day.
Exactly. The emotional impact of that loss is significantly heavier, stickier, and more painful than the fleeting joy of finding the money in the first place. That's loss aversion.
There's that classic coin flip proposition that demonstrates this perfectly.
Right.
If I offer you a coin flip, heads you win $1,000, tails you lose $1,000.
Mathematically, that is a neutral bet. The expected value is 0. But almost no one takes it.
Because losing the 1,000 hurts more than winning the 1,000 feels good.
Exactly. To get people to take that bet, you usually have to bump the winnings up to about $2,000, maybe $2,500.
You need the potential gain to be double the potential loss just to get our emotional brains to break even.
Yeah. It's that powerful.
That is wild. We are walking around with this massive bias against loss. We are wired to play defense, not offense.
And that is what was happening with the students and the mugs. For the buyer, getting the mug is a gain. It's nice, but it's just a gain.
But for the seller?
For the seller, giving up the mug is a loss. And because losses hurt twice as much, they demand twice as much money to compensate for the pain. They are charging a pain premium.
Okay, so that's college students and coffee mugs. It's a low-stakes environment. It's interesting psychology, but maybe it doesn't matter much in the grand scheme of things.
Right.
But the reason we are doing this deep dive is that this doesn't stop at the university bookstore. This bleeds into the real world, where the decimal points are much further to the right.
Absolutely. It affects the biggest financial decisions of our lives. The most obvious place we see this in the wild is real estate.
We have some great notes here from Real Estate Marketplace NW that break down the psychology of the home seller. And reading this, I felt like I was watching a tragedy unfold.
It really is high drama.
It's this collision of economic value and emotional value.
It is. Think about the typical home seller. You have a family who has lived in a house for 20 years. That house isn't just bricks and mortar to them. It isn't just square footage in a school district code.
No, it's the wall where they measured the kid's height with a pencil every birthday. It's the garden they planted with their own hands. It's home in the deepest sense of the word.
Exactly. They are endowed with memories. And then you have a buyer, and the buyer just sees a 3-bedroom, 2-bath structure that needs a new roof and has some questionable wallpaper in the hallway.
Right. The buyer is operating in the domain of market value. They are looking at comps. They're looking at interest rates. They are thinking about the gain of acquiring a property.
But the seller is operating in the domain of the endowment effect. They are facing the loss of their memories.
And this leads to what the source calls the insult factor.
Yes. I think this is so crucial to understand because it explains why so many deals blow up. Negotiations often fail not because the math doesn't work, but because the seller feels personally attacked by the offer.
Let's play this out. If I think my house is worth $500,000 because of my emotional attachment, because I love that oak tree in the back, and you offer me $450.
And $450 might actually be the fair market price. It might be exactly what the house down the street just sold for.
But you don't hear that. You don't see a rational business proposal. You hear me telling you that your memories aren't worth anything.
You hear me undervaluing your life. You feel the pain of the potential loss, and my offer doesn't compensate you for that pain.
So the seller digs in. They refuse to sell. They let the house sit on the market for months, costing themselves money in taxes and maintenance just to avoid that feeling of loss.
They would rather lose money slowly than admit that their endowment isn't as valuable as they think.
And the source mentioned something really interesting about how this spell is broken, because eventually houses do sell.
They do, but the bias usually only breaks when the seller physically disconnects.
Right, when they move out.
Exactly. Once they have moved their furniture out, or maybe they have already bought a new place and started picturing their life there, suddenly the endowment shifts.
Yeah.
The old house becomes just a shell. It becomes an empty box. The subjective reality collapses, and they can finally accept a rational price. But until that disconnect happens, they are trapped in the bias.
So Real estate is emotional. We get that. It's
Yeah.
where we live. But what about the stock market? Because we like to think of investing as this cold, calculated, spreadsheet-driven world.
We do.
We like to think that money is just math. But the report from Brown Brothers Harriman suggests that investors are just as irrational as the guy trying to sell his overpriced house.
Oh, the stock market is a playground for the endowment effect. In fact, it might be even more dangerous there because the liquidity is so high. You can make mistakes instantly with the click of a button.
The report talks about the stubborn investor. And specifically, they outline a scenario called the inheritance trap. I want to walk through this because I think a lot of listeners might recognize themselves or their parents in this.
This is a classic scenario that wealth managers see all the time. Let's say you inherit a portfolio from your grandmother.
Okay.
And in that portfolio, there is a massive position in a single stock. Let's say it's a legacy energy company or an old manufacturing firm that was big in the 80s.
And let's say this stock doesn't fit your goals at all. Maybe you're young, you need growth, and this is a stagnant dividend stock.
Yeah.
Or maybe it's just too much risk, like 50% of your net worth is now in this one company.
Which violates every rule of diversification. Exactly.
Yeah.
Any rational financial advisor would look at that portfolio and say, okay, this is dangerous. We need to diversify.
Let's sell this concentrated position and buy a broad market index fund.
That is the mathematically correct move. It lowers your risk and likely improves your long-term returns.
But the heir won't do it.
They won't do it because even though they didn't buy the stock, they just inherited it. It is now theirs. And often it has that emotional layer of grandma's stock.
Selling it feels like a betrayal.
It feels like a loss.
It's fascinating because if you gave that same person the cash equivalent, let's say $100,000 in cash, they would never go out and put it all into that one random energy company.
Never in a million years. If they had the cash, they would buy a diversified portfolio. But because the stock is already in the account, the endowment effect locks them in.
They value holding the stock more than they value the smart allocation of the capital.
And this distorts their perception of risk completely. The report points out that the endowment effect basically blinds you to the downside. You hold on to losers way too long because realizing the loss, making it official by selling, is too painful.
It's the difference between a paper loss and a realized loss. As long as I don't sell, I haven't really lost the money, right?
That is the lie we tell ourselves, and it destroys returns.
The Brown Brothers Harriman report also lists a few cousins of this bias. I think it's worth briefly name-checking them, just so we can see how crowded our brains are with these bad ideas.
It seems like the endowment effect rarely travels alone.
So what are they?
It is a rogues gallery. First, you have sunk cost bias.
That's the throwing good money after bad one.
Right. It's the idea that I've already spent so much time or money on this, I can't give up now. It's why people keep fixing a car that is clearly a lemon. They're trying to justify the past investment rather than looking at the future value.
Okay, what's next?
Then you have confirmation bias.
That's where you only read the news that agrees with you.
Exactly. If you own Apple stock, you ignore the negative reports about supply chain issues and only read the blogs that say it's going to 300. You are actively protecting your endowment psychologically by filtering out threats.
And finally, anchoring bias.
That's getting stuck on a number. I bought it at 100, so I can't sell it until it gets back to 100. The market doesn't care what you bought it at. The market only cares what it's worth today. But your brain is anchored to that purchase price as the break-even point.
It's honestly a miracle anyone makes money in the markets at all with all these headwinds.
It really is. We are fighting our own biology every time we open a brokerage app.
Yep.
We are trying to be rational in a brain designed for something else entirely.
And that brings us to the pivot point of this deep dive. We've established that this is happening. We know it happens with mugs, houses, and stocks. And for a long time, I think the assumption was just, well, humans are complicated. We are emotional. We aren't robots. It's just a quirk of our psychology.
Right. It was viewed as a psychological quirk, a failing of the human mind, a lack of discipline.
But we have this study here that suggests it goes much deeper than that. This isn't just psychology. This is biology.
Yeah.
This hardwired into our evolutionary history.
This is where we bring in the chimpanzees.
This paper's by Jones and Brosnan, and they ask the big question, why? Why did we evolve this trait? Because usually, evolution is pretty ruthless. if a behavior makes you lose resources.
Natural selection should weed it out.
Hmm.
Exactly. If you are constantly making bad trades, you should be outcompeted by the guy making good trades. So why is the endowment effect still here? Why is it so prevalent?
Enter the concept of time-shifted rationality.
I absolutely love this term.
It sounds like something out of a sci-fi movie, but it explains so much about human behavior.
It is a brilliant framing. The idea is that a behavior might look irrational today in our modern world of contracts and stock markets and eBay. But if you look at the environment where our brains actually evolved, the ancestral environment, that same behavior was perfectly rational.
We are talking about the world 100,000 years ago, the Pleistocene. No police, no courts, no Zillow.
No contract law. Exactly. Imagine you are a hunter-gatherer. You have a tool, maybe a really good spear point, or you have a piece of meat. That is a critical resource.
It keeps you alive.
Right. Now imagine I come up to you and say, hey, trade me that meat for this interesting rock I found.
I'm hesitant.
You should be. Because if you hand me the meat, I might just turn around and run away.
And I can't call the police?
There is no recourse. Defection is the evolutionary term. The risk of being swindled or just robbed was incredibly high, and resources were scarce.
So the safest strategy wasn't to be a savvy trader. The safest strategy was hold on to what you have.
The bird in the hand wasn't just worth two in the bush, it was worth your life. So evolution likely selected for organisms that had a strong, visceral aversion to giving things up.
So the endowment effect is basically a biological security system.
It is. It says don't let go, don't trade, it's not safe. It's a mechanism to prevent us from making stupid mistakes in a lawless world.
So to test this theory, to see if this is really deep in our primate lineage, they went to the Mikhail E. Keeling Center for Comparative Medicine at the University of Texas, and they recruited 33 adult chimpanzees.
They wanted to see if chimps show the endowment effect. Because if they do, it means this trait predates humanity. But, and this is the really smart part of the study, they hypothesized that it shouldn't happen with everything.
Right, because if it's a survival mechanism, it should only trigger for things that matter for survival.
Exactly. It should depend on evolutionary salience.
Evolutionary salience, that's a great phrase. So food should trigger it, but random stuff shouldn't.
That was the prediction. So they set up an experiment with two types of items. For the non-survival items, the low salience items, they used toys.
Like what?
Rope toys and rubber bone toys. Things the chimps like to play with, but they don't need them to live.
And for the high salience items?
Food. Specifically, frozen fruit juice, popsicles, and, a favorite detail, peanut butter in a PVC pipe.
Explain the PVC pipe. Why is that significant?
It's a tube of PVC with peanut butter smeared inside, and they give the chimp a wooden stick to dig it out. It's an enrichment tool. Chimps go crazy for it.
So it's a valuable resource.
It is. It's high calorie, high fat, and it mimics the natural behavior of termite fishing in the wild. It lights up the pleasure centers of their brain.
Okay, so how do they run the market?
First, they had to figure out what each individual chimp liked. They gave them a choice. Rope or bone, juice or peanut butter, just to establish a baseline preference.
Got it. So they establish a hierarchy of value for each chimp.
Then they did the endowment phase. They would hand a chimp the juice. Let's assume this is the item they liked less compared to the peanut butter. They let the chimp hold it, own it. Then the researcher offers a trade.
They hold up the peanut butter.
The item the chimp prefers, and they offer to swap.
Now, if the chimp is a rational actor, this is a no-brainer. I have the thing I like less, you have the thing I like more, I should trade.
And that is exactly what happened with the toys.
With the toys.
When it was the rope and the bone, only 3% of the chimps showed an endowment effect. They traded freely. In fact, the researchers found something really funny. The chimps were actually too willing to trade.
What do you mean?
They call it a reverse endowment effect. The chimps seem to value the act of trading, the interaction with the human, more than the toy itself.
So they just kept swapping?
Back and forth just for the sake of the game. It was like, here, you take the bone, give me the rope. Okay, now here's the rope, give me the bone.
Because the toy doesn't matter. It's not survival, it's just play.
Exactly. It's low salience. So their brains stayed in a flexible social mode. Let's trade, let's interact, this is fun.
But then they brought out the peanut butter.
Then the food came out, and the shutters came down.
What happened?
When the chimps were endowed with the food, even if it was the food they liked less, the trading stopped. 42% of the chimps showed a strong endowment effect.
42%.
If they had the juice, they kept the juice. If they had the peanut butter, they kept the peanut butter. They refused to trade for the better item.
They refused. The moment the item was food, the brain switched from let's play to mine.
The instinct to protect the resource overpowered the rational desire to upgrade the resource.
That is incredible. It completely validates the evolutionary theory.
It does. It tells us that the endowment effect isn't a glitch across the board. It is a targeted mechanism. When the brain recognizes survival resource, it locks down. It puts up a firewall.
And the implication for us humans is that our wires are crossed.
Right. We have these two systems. We have the toy system, modern, analytical, willing to trade, social, and we have the food system, primitive, emotional, hoarding, protective.
And the problem is that our modern brain treats a stock portfolio like a tube of peanut butter.
Exactly. That is the fundamental mismatch. We confuse abstract assets with survival resources. When you look at your house or your retirement account, your primitive brain sees safety, it sees survival, and it screams, do not let go, even if the math says you should.
We are using Stone Age software to run Wall Street hardware.
That is the perfect way to put it. We are trying to run a modern economy on an operating system that hasn't had a major update in 100,000 years.
And that operating system is very risk-averse when it comes to giving up resources. So we see this mechanism in chimps. We see it in the market. But does it look the same for everyone? Because there is a lot of talk and, frankly, a lot of stereotypes about gender differences when it comes to money and risk. You hear it all the time. Women are more risk-averse. Men are reckless gamblers.
This is a really important area of research, and we have a study here by Wieland and others titled Gender Differences in the Endowment Effect. It tackles this stereotype head-on.
The stereotype being that women are more risk-averse than men.
Right. That is the general consensus in a lot of economic literature. Men are the hunters, the gamblers, women are the gatherers, the savers. But this study wanted to slice that data a bit thinner.
How so?
They wanted to see if that holds true for buying risk versus selling risk.
Right.
Because as we've just learned, buying and selling are two very different psychological states.
Okay, so let's break this down. They looked at willingness to pay, or WTP, versus willingness to accept, WTA.
Correct. So first, the buying frame. Imagine I come up to you and say, I have a lottery ticket here. It has a 50-50 chance of winning $100. How much cash will you pay me to buy this ticket?
So you are asking me to buy risk. I have safe cash in my pocket, and I'm trading it for a gamble.
Exactly. You are acquiring uncertainty. And in this specific scenario, the stereotype held up. Men were willing to pay significantly more, roughly double in some cases, than women were for that ticket.
So men were more eager to jump into the gamble.
Yes. In the buying frame, men are more comfortable seeking gains, taking that active risk. They are more likely to say, sure, let's roll the dice, let's see what happens.
But that's only half the story. That validates the stereotype, but then the study pivoted.
Then they flipped the script. They did the selling frame. They said, okay, you already own this lottery ticket. It's yours. How much cash do you demand to sell it to me?
So now I own the risk, I hold the potential winnings, and you are asking me to give it up.
And here's where it gets fascinating. The gender difference vanished. Gone. Women would not accept less than men. Once the women owned the ticket, they valued it just as highly as the men did. They demanded just as high a price to give it up.
That is a huge twist. So women aren't risk-averse once they are in the game.
Exactly. Once the asset is endowed, the protection instinct kicks in, and it kicks in equally for everyone.
So interesting.
In fact, because the women started with a lower buying price but ended up with the same high selling price, they actually showed a larger endowment effect mathematically. The gap was wider.
So why the difference in the beginning? Why were they hesitant to buy if they value it just as much once they have it?
The researchers dug into this. They found it wasn't necessarily risk aversion in the sense of being afraid of the outcome. It was gambling aversion.
What's the difference?
They asked participants about their attitudes towards gambling questions like, is gambling fun? Or is it a waste of money?
And let me guess, women scored lower on the fun scale.
Significantly lower. Women generally saw the act of gambling as less enjoyable. It wasn't a thrill for them. It was just a nuisance or a bad bet. And that attitude mediated the result.
So it's not that they are afraid of the value. They just don't get a dopamine kick out of the purchase. They don't get the thrill of the chase.
Right. When the researchers switched the item from a lottery ticket to something else, like a gift card, something with a known value, the gender difference often shrank or disappeared.
This is so important because it reframes the narrative. It's not that men are better at risk or braver.
No.
It's that men might be using risk-taking as a status signal.
The study speculates on that. They suggest that for men, active risk-taking, the buying of the gamble, might be an evolved attribute of masculine psychology. It's peacocking with your wallet.
Look at me, I can afford to take this chance.
I'm resource rich. And this connects back to the chimps protecting what you already own. That isn't about gender. That isn't about showing off. That is survival.
That is universal. Male, female, chimp. Once you have the resource, you guard it.
There is no gender difference in the instinct to hold on. When something is ours, we all become fierce protectors.
Possession is 9/10 of the law, and apparently 100% of our biology.
It really seems so.
So, we have covered a lot of ground here. We know the endowment effect ruins real estate deals. We know it traps investors. We know it's triggered by evolutionary salience, thanks to the chimps and their peanut butter. And we know it's a universal instinct that overrides gender differences. It's a pretty comprehensive diagnosis of the human condition.
It is. We are all walking around with this bias.
But we can't end the deep dive without talking about the cure, or at least the treatment. Because if this is biological, can we actually turn it off? Can we deprogram ourselves?
The short answer is no. You can't turn off your biology any more than you can decide not to be hungry. The instinct will always be there, but you can manage it. You can build systems to override it.
The Brown Brothers Harriman report offers some strategies. And I want to go through these because I think they are genuinely useful for anyone listening.
Definitely. The first strategy is metacognition.
Thinking about thinking.
It sounds academic, but it's actually very practical. It just means being aware that your brain creates this subjective reality. Just knowing that the endowment effect exists is half the battle.
So when you feel that gut instinct that says, my house is worth $1 million, you have to be able to step back.
You have to catch yourself. You have to say, wait, is it really worth that? Or is that my ownership bias talking? Am I feeling pain because this is a bad deal? Or am I feeling pain because I'm letting go?
You have to learn to distrust your own gut feelings about value, which is the opposite of what we're usually told. We're told to trust your gut.
In finance, trusting your gut is usually a terrible idea. Your gut is designed for the savannah, not the stock exchange. Your gut wants the peanut butter. Your gut does not understand PE ratios or interest rate curves.
Okay, strategy number 2, financial literacy.
This helps reduce the emotional noise. The more you understand the math, the actual probability and valuation, the easier it is to override the feeling. The report notes that experienced traders show less of an endowment effect than novices.
They've done it enough times that it becomes abstract.
Exactly. If you trade cards all day or you trade stocks all day, the item ceases to be my card or my stock. It becomes asset class B. It becomes data. The more you can view your possessions as data points rather than physical extensions of yourself, the safer you are.
But even the pros aren't immune.
No, everyone slips up. But education builds a buffer. It gives you the tools to analyze the situation logically before your emotions hijack the steering wheel.
And the third strategy, this one is my favorite because it's so actionable. It's called consider the alternative.
This is the golden rule for overcoming this bias. It's a mental trick you play on yourself to force a reset.
How does it work?
Let's say you are holding that stock you inherited from grandma. You are agonizing over whether to sell it. The strategy is to ask yourself this specific question. If I didn't own this stock today, and I had the cash equivalent in my hand, would I buy this stock at this price?
That is such a powerful reframe.
It changes the default setting. Instead of, should I sell, which implies loss, you ask, should I buy, which implies gain.
So if I have $10,000 in this energy stock, I imagine I have $10,000 cash. I look at the stock market. Would I buy that specific energy company right now?
And if the answer is, no way, I'd buy an index fund or I'd buy Apple.
Then you are only holding it because of the endowment effect.
Exactly. You are suffering from the bias.
Yes.
And you should probably sell immediately and buy the thing you actually want.
It forces your brain to generate reasons for the opposing position. It breaks the mind loop.
It's aggressive cognitive therapy for your wallet. It forces you to look at the opportunity cost, not just the sunk cost.
I love that. Cognitive therapy for your wallet. Because we really do need it. Our brains are constantly trying to trick us into staying put.
They are. We are wired for stability. We are wired to keep the peanut butter. But in the modern world, stability stagnation is often the riskiest move you can make.
So let's wrap this up. What are the big takeaways for you?
For me, the biggest takeaway is the biological depth of this. The fact that 42% of chimps refuse to trade their peanut butter tells me that this isn't just us being stupid or irrational. It's an ancient, evolved mechanism.
We shouldn't beat ourselves up about it. It's not a character flaw.
No, we should respect the instinct. It kept our ancestors alive. It got us here. But we also have to recognize that the context has changed.
Context is everything. In the wild, holding on to food is life or death. In the modern world, holding on to a losing stock is just bad math. It's maladaptive.
And I think the gender aspect is fascinating, too. It reminds us that while we might approach risk differently, we all end up in the same place. Once we have something, we are all equally stubborn.
It unites us all. Men, women, chimpanzees. Nobody wants to give up the peanut butter.
Nobody touches the peanut butter.
But seriously, it brings us back to that concept of time-shifted rationality. We are walking around the 21st century with brains designed for the Stone Age.
That is the fundamental struggle of modern life. Learning to recognize when our ancient instincts are serving us and when they are sabotaging us.
And that leads to our final thought for the listener. The next time you are struggling to let go of something, whether it's a car, a house, an investment, or even just an old sweater you haven't worn in 10 years, stop. Take a breath and ask yourself, is this a survival resource?
Is this actually critical to my life? Is it the peanut butter? Or is it just a rope toy?
Because if it's just a rope toy and you can trade it for something better, you should probably make the trade.
Don't let your inner chimp run your portfolio.
Words to live by. Thanks for diving deep with us today. We'll see you next time.
See you next time.